All right, so let's go back into more inflation debunking, shall we? Debunk. All right, this is from Trading Economics, the U.S. government spending related to GDP. Government spending in the U.S. increased to 44% in 2020 relative to the gross domestic product, 35.68% in 2019. So here it is in 2019, and it jumped into 2020 because of the insanity of the epidemic. Shutdowns, not because of the epidemic, the shutdowns. And you can see that's the lowest it was been on since 2001. Now, here's Obama. Look at that. Under Obama and then the Trumpster, government spending relative to GDP fell from, what's that, 44 to 35%? Interesting. Why? Because the economy was growing. The GDP was growing, not extraordinarily. Not Reagan-esque at 4%, but certainly 2%. Obama never got 3%, but when you have a big economy like we have, a 2 to 2.5% growth rate ain't too shabby, my friends. Now, this is just an anomaly. We hope it will be. It's not going to keep going. So the spending will stop at some point as long as the government spending gets under control, which it will. It really depends on who takes Congress. So we'll get in that in just a second, but it will. And then the GDP will kick back in. All right, so I want to show you something. So look at this. This is 1970, 1980. That is the time we had the highest inflation on record other than times of war for the United States. Peacetime inflation, the highest inflation. Government spending relative to GDP was the lowest it's ever been, except for right there, 2000. And then interesting. So we could make a correlation. Low government spending proportion to GDP means what? Means high inflation? Well, I just say more likely is low growth of the government. The GDP isn't growing very much. But be that as it may, there you go. Now Reagan takes office and he spends. But this is right here, 1982. The spending went up, and this is where David Stockman and all the others saying, oh my goodness, too much spending. They're going to devalue the dollar. We're all going to be, I guess the Japanese yen. Japanese yen is going to take us over. Inflation started dropping down. It's pretty significantly, by the way. Here's George H.W. Bush. All right, spending relative to GDP went up again. Here's Clinton being taken by Republican Congress. Spending relative to GDP went down, which just means one of two things are happening, or one of three things. Spending was going down, the GDP was going up, or the spending was going down, relatively speaking, and the GDP was going up. Something like that. There's some combination thereof. So you can see spending and GDP. Spending was going up, GDP was going up. That's kind of like flatlined. Spending was down relative to GDP as a percentage-wise, and that's what inflation was. Inflation was being nipped in the bud. Whip inflation now. Then Bill Clinton, there's a peace dividend, so the government was spending less, and then Republican Congress in 94 helped. And so spending was going way down. The GDP was going fine. Bush comes in, boops. Spending relative to GDP. The GDP didn't do much. The spending went up much more highly than the GDP was growing. Then Obama comes in, spending wasn't low, but spending went down relative to the growth of the GDP, and now here we are here. Not inflationary. There's nothing in there that someone can say that's inflationary. All right, but people say, but Josh, government debt to GDP, let's look at that. All right, I just say, let's take a look at it, shall we? All right, so here's the World War II right here at the end, and then what you see is U.S. gross federal debt to GDP. Gross federal debt in the United States increased to 107% in GDP in 2020. We're above 100%. Oh my goodness, it's inflationary. No one's going to buy our bonds. Oh, the dollar's collapsing. All right, so we have in World War II, debt to GDP is 120. The first time we got over 100% debt to GDP is right there about 2015. Thanks, Obama. But remember, the debt is just the accumulation, the cumulative deficits combined. All right, the debt is just the cumulative deficits combined. I hope that makes sense. So every year we've been taking on debt, other than a couple years in the mid-90s when Clinton and Republicans were in charge. There has been no balanced budgets, never mind a surplus. There's like 2 to 3 years under Clinton with a Republican Congress we had a surplus. Other than that, it's all been deficit spending, which means deficits adds to the deficits, deficits adds to the debt. And deficits as to the debt. The debt is the accumulation of all previous deficits. And what you see here is from 1950, I guess that's 48, to 1968, we had significant debt to GDP decline. Look at that, man. 19 right there. So 1968, significant debt to GDP decline. What happened to interest rates and inflation? Zoops. From 1968 to 1984, the hyperinflation, they weren't hyperinflation, we'll say the inflationary years of the U.S., debt to GDP was the lowest it had ever been in the modern era. Look at that. Nothing even comes close. It's below, I mean, we're talking 30% debt to GDP. That was inflationary. Absolutely. Was it because of the low debt to GDP? I don't know, but we already talked about government spending relative to GDP was the lowest it had been. Government debt to GDP was the lowest it's been as well. And because we had low government spending and low government debt to GDP, you could then turn around and say it not only was not inflationary, I mean, not only does government spending not cause inflation, the opposite does. I don't know if I'd want to make that correlation. Causation is not correlation is not causation after all, but there you go. I mean, there it is right there. Low government spending and low debt to GDP, we look at it right now, led to high inflation and low GDP. That's just a fact. Now, again, would you want to make that a case that one leads to the other? I would not, but there you go. Higher government spending under Reagan, higher debt to GDP under Reagan led to higher growth of the economy. All right, and then here's Bush, not much growth here. Here's Obama, not much growth there either, I will tell you. That's true. So we have spent more because, again, debt is accumulation of deficits. So our debt rate has gone up because we've accumulated all this other debt from previous years. But at the end of the day, the amount of debt relative to GDP is still, look at that. You cannot say inherently high debt to GDP is inflationary and is going to make the dollar worth crap. There's no evidence of that. And we'll go here in just a second. But I want to point out something too. Debt to GDP. All right. Think about just for your own family situation. All right. GDP is your income. All right, so let's say you have $100,000 of a mortgage and you make $50,000 a year. All right, what's your debt to GDP? All right, your debt to GDP is 2 to 1, just for simplicity. $100,000 mortgage, $50,000 income. Your debt to GDP is 200%. All right. Now let's say you double your income. Now you get $100,000 income, but you're going to buy a $300,000 house for a $300,000 mortgage. What's your debt to GDP? All right, what is it? Well, guess what? It's 300%. You've increased your debt to GDP by 50%, all right? Now you've increased your income by 100%, but you increased your debt to GDP by 50%. However, because your debt to GDP before is already so high at 2 to 1, now the debt to GDP is 3 to 1. You're like, oh my goodness. But the issue is your income has risen more. Does that make sense? Your income has gone from from 50,000 to 100,000. I hope that makes sense. Your debt to GDP, your debt to income essentially went from 2 to 1 to 3 to 1. That's a 50% increase, but your income went up by how much? Your income went up by 100%. Now you can say, but my total debt went up by 200%. That's true. Do you have the ability to afford that debt with your higher income? That's the question. And the issue with you as a family, you're saying, yeah, I can. That's why I can buy the house, because I can afford it. Now, whether or not that's true, what if you got laid off, what if the economy falls, all that stuff, I get all that. But in of itself, what most families do is their income goes up, their GDP, they borrow more, they get a bigger house, they get, I don't know, school tuition, student loan debt and all that, because they're saying it's an investment into future things. Now, this is where the government spending is bad. We're investing in, child care. We're investing, in solar panels. That Clinton made that argument, is right. I mean, it was a good argument to make. He said, we're not spending, we're investing. That's the argument you got to make. You say to invest, we expect an ROI, return on investment. I don't trust the Democrats as far as I can kick them in that regard, but it's a good argument to make. We're investing in solar panels, all right, whatever. We're investing in children. We're investing in infrastructure. Now, we also know they're investing a lot of just spending on favorite groups, teachers unions, stuff like that. That's not investing. That's just spending, making sure we're sprinkling dollars on favorite groups. That's a fact. But you do invest to get a higher return on investment ROI, because of the investment you make today is a cash flow, it's a deficit. And that where you take on a debt because you don't have the money to pay for it, so you take on a debt to finance an investment which you think will pay off that debt in the future. Now, whether or not it comes to fruition remains to be seen. But we just look at the history of America and we see our debt to GDP. I mean, I'm sorry. This right here, our debt to GDP is the lowest it's ever been, and the economy was not doing much. This right here, the debt to GDP was much higher than it was before by a factor of 50%, and the economy was roaring. That's just a fact. So you can't, there's no correlation you can say this happens, none. So let's just go to Japan now. We're going to go to trading economics. Again, I always look at Japan. People say, Japan. I mean, look, man, you always got to explain Japan, and you can't. There is no way to explain it other than we're wrong. I mean, all the stuff we've been saying is wrong. So let's go to spending. Do they got spending on here? We'll go to debt to GDP. I don't see any spending on here. We'll go to, we have, I've talked about this a million times Sunday, but here's a debt to GDP. And they've been over 100% since going back to 1995. And we've had no inflation, no growth, no inflation, no interest rates. Just, man. So they got government spending to GDP. Watch this. Max, right here. So they don't give me a chart like that, and they don't go back that far. But anyway, you can see government spending to GDP. They're right about where we are. We're about 44% in 2020. We didn't even have them for 2020. We only have them in 2018. I bet they're up here too. I mean, so look, we're at 44%. They've been at 40, 39, 41, 40, 41, 40, 39. They've been well above us since 2008, and yet where's their growth? Where's their inflation? Where's their devaluation of the currency relative to hyperinflation? It's just simply not there. So, so let's just do one other thing here too. Just kind of going back to that. I don't know if we got government spending to GDP. No. Let's go to debt to GDP. Russia, debt to GDP 14%. Inflation 5.79. Saudi Arabia, debt to GDP 28%. So you think debt to GDP being low is indicative of a strong economy. Inflation 4.9. Australia, debt to GDP 24%. Inflation 1.1. Taiwan 28%. Inflation 2.9. Bangladesh, you can see this, man. 33%. Chile, inflation 2.9. Nigeria is 35%. Inflation. Why is the debt to GDP? Because no foreign entity is going to loan them money. It's just not happening. Hong Kong, Indonesia, Turkey. The debt, here's Sweden. Finally got one with a debt to GDP of a European country. I guess that's the first one, yeah. And well, I guess Russia considered Europe, but anyway, well, I guess Turkey too. But anyway, but look at Turkey's inflation, 17.4. So debt to GDP being on the low end, Turkey's got 17.4 inflation. How do you explain that? So then we go the other way, debt to GDP. Well, in Venezuela, debt to GDP because that's a commie, so economy got. But here's Japan, 266. Actually, Venezuela just overtook Japan. Here's Japan, 266, inflation negative. Here's Italy, 155, inflation 1. Here's Singapore, 131, inflation 1. Here's Spain, 120, inflation 2. Here's France, 115, inflation 1. Here's Belgium, 114, inflation 1. Here's the U.S., 107, inflation 1. So here's UK, 100, inflation, less than 100 basis points. All right, so we just saw something happen. I saw something that just posted here about oil extends losses. Oil prices fell second day with WT crude. Okay, U.S. job cuts dropped 21-year low. Right on, man. U.S. job cuts dropped to because no one's working. Wait till we see what happens when they get rid of the stimmies. Give me my stimmy. U.S. labor productivity rose by an annualized 5.4% in the first quarter. So good stuff, man. And I'll read you another call. Anyway, stop worrying about it. Stop worrying about it. Inflation. All right, we'll see you.